Testing. Okay, everybody, how are you this afternoon? Maybe morning if you're out in California. So if you are not, if you're not muted, please mute your system. Keep it muted, please. Okay. We'll give it one more minute and then we'll get started. To everyone, yes, this is going to be recorded, and also the presentation will be emailed to you within the next 24 hours after we have finished. Okay. All right. All right, we will get started. Again, I have to ask that if anybody is not muted, please do. We want to make sure that there isn't too much background noise, so you really don't have to connect to audio at all. If you can see the screen, you are good. We would ask that you, if you have questions or any of the other issues, please use your chat box, as that's where we will be responding back. So as we go through, if you have any questions, just put them in on the chat box and we will respond to them in that way. My name is Marv Stockert. I will be your host today. And if after this you feel that you would like to sign up for some tutoring, I will be the tutoring instructor, and we'll have some fun doing that. So here we go. Okay. Just a quick thing about the testing. When you get there, do not bring anything in, nothing, no, other than your driver's license. No calculators, pencil, purse, billfold, cell phones, because they won't be allowed, or they're going to require you to put them in a locker. So do not bring those in. Now, there will be a calculator there, but it will only do minus, times, divide, subtract. It will not allow you to do mortgage payments or APR. The calculator won't do that. You have 190 minutes to answer 125 questions. 10 of those will be thrown out. So you have to have 75% of 115 questions, or 87. Now, just a couple of hints in helping you prepare. When you go to the test and open it up, read it, the question, very slowly. And as there are many double and triple negatives as well as scenario questions, but do not take any more than 30 seconds for each question the first time through, or you might run out of time. So read it twice, 30 seconds, then move the question up on hold or review. If you're not sure, or you have other instances that's you're not sure, or you don't know. Now, you will have to answer the question before you will be able to move on. Now, when you go back up the second time, you open up the question, but please do not answer or change an answer unless you are absolutely sure that it's wrong. I find people who are second guessing or overanalyzing the questions, and then they change it. They could have had it right. I've seen students just in the last 10 days. They would have passed the test. They went in and changed 3 answers and ended up missing by a point. So my recommendation is, unless you know for a fact that it's wrong, don't change it. Now, I'm not trying to scare anybody a bit, but I want you to know this is not going to be a cakewalk. The pass rate is 58% the first time taking the test. So 42% of the people taking the test, oh well, they get to take it again and pay another $110. Now, the study materials, and if you are using practice tests, they're okay, but don't look at the score. The score means nothing. You get yourself overconfident because I got an 80 on the test. Who cares? That's only on those questions. You've got to make sure that you understand that if you have questions wrong, let's find out why they're wrong. Those are the ones that I would put on 3x5 cards so that you can review that information over and over until you get it right. Now, reading the questions twice. Now, we're going to go into fair lending, fair housing, and ECOA. The biggest thing here is any person wanting to apply for a mortgage must be allowed to do that unless they are under the age of 18. Now, under the age of 18, of course, they can't sign for a mortgage. Also, not only do they have the right to apply for a mortgage, but they have to be given equal credit opportunity. You can't have different underwriting criteria for each different nationality or ethnicity. HOPA, very important law, Home Ownership Equity Protection Act. It is under Truth in Lending and Reg Z. It covers predatory, abusive lending, negative amortization, and there's only one program today that allows negative, and that is reverse mortgages. There are no prepayment penalties allowed on any of the 5 agency products, meaning that if you tried to pay your loan off early, they could charge you a penalty, but not right now. Balloon lending, subprime, equity stripping, or it also could be called churning. And the ability to repay is a real hot button. With information on the application, would you be able to, if you had to go to court and defend yourself, that you proved to the borrower that they had the ability to repay? If you can't, the borrower could take you and or the company to court. Now, balloons, the minimum is 5 years. Now, if you see a term like 360 over 180, that means it's a 15-year balloon. The loan is going to be amortized for 30 years for 360 payments. Balloon will be in 15 years. Now, average prime offered rate, very important item also. That is the APOR index, which is issued weekly. And weekly and 15-year, 30-year could be 25, 20. Now, what it happens is the index, the APOR index, is added to the high cost or high lending triggers. Those two numbers together, your APR, your annual percentage rate, cannot be any higher than that. So for an example, if the APOR trigger today was 4%, first mortgages for a high cost loan is 6.5. You would add 4% the trigger, the index, the 6.5% trigger. That means your APR, annual percentage rate, cannot go over 10.5%. If it does, well, now you've got a high cost loan, and it will require counseling, escrows. Any loan over 80% will require mortgage insurance, and a full appraisal will be required. You will not be able to get by with an appraisal waiver. So that is how it is calculated. Index plus the trigger, your APR cannot exceed that. Now, high price lending, the triggers are different. 1.5%, 2.5% on a jumbo, 3.5% on a second. The concept is exactly the same way. Index of 4 plus 1.5% on a first mortgage, your APR cannot exceed 5.5%. If it does, you're not going to be able to lock it, and your company is going to have to do some other things in order for that loan to be sold. Now, under high priced, mortgage insurance is required, escrows are required for the first 5 years, and a full appraisal is required. Now, equal credit, 5 parts, and if you see ECOA, Equal Credit Opportunity Act, or Reg B, all means the same law. The 5 parts are age, discrimination, underwriting, appraisal, and adverse action. That means age, you got to be 18 or older to get a mortgage. Now, the discrimination items, you cannot use any of the items listed to make or decline a loan. They have to be kept neutral, so male or female. Marital status, you can only ask married, unmarried, or separated. Race and color, common sense, let's not go there. There's no reason or no need for it in the mortgage business. Age, now this age, you can't say to someone, well, you're kind of old, or you're kind of over the hill, or Charlie, you're 70 years old, and you want a 30-year fix. Do you really think you're going to be around at 100? Well, whether he is or not doesn't make any difference. If the borrower qualifies, then the loan is made. Now, religion, never ask about that. National origin, never ask. Now, public assistance, that says you have to consider if somebody's on public assistance. Now, 9 times out of 10, you're never going to be able to count it. Why? Because usually public assistance is only for 1 year at a time, and you need 2 to 3 years worth of potential income going forward. Now, underwriting, 30 days from when the complete underwriting package is given to the underwriter, a decision must be made, approved, canceled, or rejected. Now, if the loan is suspended because there's documentation missing, well, that could extend out to 90 days. But if it's rejected, well, Now we got a different issue, which we'll get into in a second. Appraisal must be delivered to the borrower no less than 3 business days before closing. Now, if they waive off that they don't want the appraisal, but they still have the right from declination or closing or funding, they can still request a copy of the appraisal at no cost. Now, adverse action. If you are declining or canceling a loan, it must be sent, the adverse action notice must be sent to the borrower, telling them why. Here's rejection. Here's why it was canceled, because you're not responding or supplying us the documentation you need. So a quick trick maybe. If you can remember 6 words: age, discrimination, underwriting, appraisal, and adverse action, those would be words that I would trigger that I should look at ECOA. Okay. Now, Fair Housing Act, which was amended by ECOA, had 3 other areas. Disability. You cannot refuse a borrower for any reason from applying because they are physically or mentally disabled. You cannot discriminate against somebody because, oh, well, you got 8 kids. I'm not sure we're going to be able to get a loan for you. Or you can't say to a woman that is pregnant, well, I'm not sure we're going to be able to count your income because you're going to be going on maternity leave. Not acceptable. Now, age is exempt under this law for 2 reasons. You got to be 62 to get a reverse mortgage. 55 and over subdivision, you got to be 55. So, another hint. If the word age is in a discriminatory question, you should look at ECOA. If the word age isn't in a discriminatory question, you should probably look at fair housing. I'm not going to say that's always the answer, but it's a place I'd start. Now, Fair Credit Reporting Act. The tri-merge credit report is not to be given to the borrower. It is underwriting only. You can tell them their credit score, but they cannot be given their tri-merge credit report. Now, risk-based disclosure is given to tell the borrowers that their credit could determine the pricing on the loan or which programs they are going to be able to qualify for. Now, if the loan is turned down because of credit, number 1, you have to list all of the 3 credit agencies and all of the contact information. So if the borrower has an error or dispute, they know where to go. Now, every borrower's credit score, you're always going to use the middle one when you're underwriting. But on this disclosure, if you've got 2 borrowers, one is 720, one is 750, you will use the lowest of those 2 middle credit scores, or you will use 720. That's what the score you would list. Now, the 3 credit agencies are Experian, Equifax, and TransUnion. Probably should remember those. Now, fair and accurate credit transactions are the FACT Act. That amended fair credit. Every consumer has the right to receive at least 1 free credit report every year. Now, they can get more, but at least 1 is required if they want it. Now, every consumer has the right to put a fraud alert or a freeze their credit if they feel that their credit has been compromised or their identity has been stolen. Now, make sure you always tell the borrowers, do it all with all 3 agencies. These agencies don't always get along, and they're supposed to be sharing the information, but in some cases they don't. Now, truncation, your debit card, your credit card, or your bank deposit receipts. Only the last up to 5 digits of your account number can be shown. If they show more, it's a violation. Now, red flags, which is enforced by the Federal Trade Commission, 2 things. If you call your bank, your credit card company, and want to change any of your information, they will have to contact you by email or text or letter, whatever you've got set up in your account, asking, in fact, did you request those changes? Unless you respond, they're going to make the changes. So if somebody's hacked into your account and done it, then if you don't respond back, that information is going to be changed. Now, the big thing here is every person in your company is to be trained how to identify a breach of security, meaning somebody stole a computer, somebody hacked into the server. As soon as that's determined, you should be alerting your compliance officer or senior management. And within that 30 days, in the next 30 days, everybody in the database has to be sent a letter or email stating, we've had a breach of security, and here's what we've done to protect you. That's as far as it's going to go with that. If you don't do it within 30 days, you'll have some major fines. Ask Chase. Now, Gramm-Leach-Bliley. Whenever you see Gramm-Leach-Bliley or GLB or Reg P, privacy, 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 privacy. Everything about privacy. Now, every year you get a notice from your company stating, here's what we do with your data. We give it away, we sell it, we do whatever. And that's called the NPPI. You have 30 days from that notice to call up these companies and say, listen, no mas. You can't give any of my information to anyone, sell it, give it away, whatever. Now, phishing or pretexting. And I'm sure we've all heard about somebody claiming to be the IRS on a text and saying, we're having problems with your social security number. Please respond to this if your social security number is different than the one that's listed below. Well, you know, if you do that, guess what? You just gave up your identity. Now, safeguard rules says whenever you are not using your files, they are to be locked up in a desk drawer or filing cabinet. If your computer or files are on the computer, there must be a lockout after a few minutes. And all records, every part of the file must be kept for 3 years, and the closing disclosure for 5 years. Now make a note, safeguard rules is also regulated by the Federal Trade Commission. Now, Reg C, the important, HMDA, Home Mortgage Disclosure Act. Now, maybe a way to remember this, because Home Mortgage Disclosure Act requires you to collect data. Well, Reg C is for collection. Collection of data meets HMDA. Or HMDA means I got to collect data. Oh, well, that's Reg C. Just maybe a quick hint. Now, any companies that underwrite or fund loans must file a HMDA report annually in 2019 by March 1st or quarterly starting in 2020. Now, so that means banks, credit unions, mortgage bankers all have to report. Mortgage brokers are exempt because they don't underwrite or fund loans. Now, a way to know when you have to give the loan estimate or report any information. is the word pencil, an acronym. P for property address, E for estimate of value, N for name, C for credit or social security number, I for income, L for loan amount. Now, if you don't have all 6 of these, you don't have to give an LE until you have them. Okay, now the agency that collects this data is FFIEC. Now, do not call. Again, law regulated or enforced by the Federal Trade Commission. Now, unless you got a big piggy bank, I'd probably not start calling anybody unless you know that they're not on the do not call list. $40,000 up to $40,000 per violation per day. Now, if you pull data from the do not call database, can never be over 30 days old. You'd have to re-pull it. Now, there's 2 exemptions. If you have an existing business relationship, you have 18 months, even though they're on the do not call list, to call them. Or you can call them 90 days on a pre-qual. But whenever you make phone calls or reach out to them, you better document who, what, why you did the phone calls. If you don't, it is a violation. You got to keep that solicitation information for 2 years. Now, an internal do not call. If you're a consumer or a borrower sends a note to you or your company and says, listen, I do not want to receive any more solicitation or marketing materials from you. At that point, that overrides the 18 months and the 90 days. So you would not be able to do anything in reaching out to that customer in any way. Now, the exception would be the servicing department because they got to follow up on delinquencies. Now, under TILA and Reg Z, very important items. There's 8 items that are covered. MDIA, Mortgage Disclosure Improvement Act, advertising, HOPA, loan estimate, annual percentage rate, qualified mortgage, loan officer compensation, and charms booklet. All of those items are covered under TILA. Now, MDIA is the 373 rule. 3 business days from the signed application by the borrower, you got to get all of the initial disclosures. When they give you the signed intent to proceed, they have to wait 7 business days before they can close. Now, the last 3, if the initial CD must be delivered no less than 3 business days before closing. Now, if there's a program change, prepayment penalty added, or the APR tolerances are exceeded. Now, the APR tolerances are if your fixed rate APR increases by more than 1/8, or 1/4 on an arm, you would have to issue a new CD, and now there's a 3 business day delay. So it's only those 3 items. Now, advertising, the company name, NMLS number, phone number, and address must be on the materials, as well as the equal housing logo. And if there is a number, mortgage amount, interest rate, you must have an APR, annual percentage rate. And that APR number has to be equal or larger in the font size. Again, HOPA, we've already covered that. Loan estimate. must be delivered within 3 business days from the signed application, with all of the terms, all of the costs, everything about what you're going to be doing for that customer. Now, the annual percentage rate, the simplest way to understand it's the cost of the loan. It's all of the interest and all of the costs paid at closing, plus every cost that's going to be paid throughout the life, including mortgage insurance. Now, all of that together, divided by the loan amount, you've got your APR. So the easiest way, it's the cost of the loan. People still get confused. Well, you're telling me my interest rate's 3.875. Now you're telling me it's 4.274. No, I'm not telling you that. The interest rate you're being charged is 3.875. Everything that you're going to be paying over the life of the loan will give you a cost of whatever your APR is. Okay, qualified mortgage, very, very important today, which could be, this item could be changed in the next year. Now, there's 2 ways that you as loan officers could be given safe harbor, and that means that you've proved the ability to repay, which will prevent a lawsuit being filed against you. One is 43% max debt to income and no more than 3% in fees. That's option 1. Option 2, approved eligible from Fannie or Freddie and meet the high price lending standards or limits. If you meet either one of those 2, you're good to go. If not, be prepared, because as soon as you close that loan, if you don't meet those 2, 3-year window, you could be sued, pay up to 3 years worth of interest, all the costs. So unless you got a $50,000 piggy bank, I'd probably stay away from it. Now, commissions are limited to the basis points that you and your company are going to agree upon. And if you're a 100 basis point loan officer on a $200,000 loan, your commission would be $2,000. No terms of any kind can be used to pay your commission. No rates, no programs, no costs, no nothing. Based on the number of bonuses, could be based on the number of loans originated, the dollar amount that you originated, but your bonuses can never, ever be above 10% of your last 12 months compensation. Now, Charms booklet must be delivered to all borrowers on any ARM loan, purchases or refinances. And that's from the signed application. Okay, Reg N regulates advertising. If you don't have it, don't advertise it. You can't use any bait and switch tactics to get people to call you to sucker them in so that you can switch them over to either a different program or higher rates. And you cannot use any words or sentences that would give the borrower any indication that they shouldn't apply with you. Not a good idea. Digital delivery on all of your disclosures, 3 business days from the signed application. And it's only on email, DocuSign or e-sign, not faxing or email. You have to get the borrower's approval, written approval, identification that they are who they are. They can go back to hard copy if they wish. And at the best of your ability, you must determine if the borrower has the technical skills to do it. Consumer Financial Protection Bureau. You want them not in your sites, or that you in their sites. because it's only going to cost you some money. So, or fines, or suspensions or prosecution. So stay away from that. Now, RESPA, the loan toolkit, must be given to all borrowers on purchases and all borrowers on refinances also. Now, on a purchase, one of the, there's one for the seller, one for the borrower. But the borrower's copy is not to be given to anybody without the borrower's approval. I'm talking about the attorneys, anything. You can't give it to anyone. And they're all going to be screaming for it, but you can't give it to them. Now, the HELOC booklet is required on all applications when your home is on the line. Now, mortgage brokers can't do HELOCs. Most mortgage bankers won't. That's pretty much a bank and credit union items that they will do. Now, I would like to have you make a point here on the LE and the CD. You cannot use those on HELOCs or reverse mortgages. There you have to use the GFE or good faith estimate, TIL, truth in lending, and HUD-1. So those are documents, but only on HELOCs and reverse mortgages. Now, Section 8. Nothing of value can be or paid or received for any referrals or kickbacks. Now, also, if you are doing any joint advertising with a realtor or a builder or anybody, you must show that the costs have been split equally, or you better have good documentation why you or the other party is paying more or less. Now, the affiliated business disclosure is to be given to the borrower within 3 business days when the MLO has disclosed that there could be a conflict of interest. They're a realtor and an MLO, or an MLO, their family or company owns as little as 1% of a third-party company. Then that affiliated business disclosure given to the borrower saying, I could have a conflict and I could be receiving money from both sides of the transaction. Okay. Homeowners Protection Act, 80% loan to value. Must have MI above. Now, once the loan gets down to 80%, the borrower can request the MI to be dropped, but it's at the option of the lender. And I can assure you, if they've had any lates or delinquent payments, it's not going to be dropped. Now, once the loan has reached 78%, the MI has to be dropped. Now, this is only on conventional loans. This has nothing to do with FHA, VA, or USDA. Now, the Bank Secrecy Act, if fraud or money laundering are detected, the file is to be given to your compliance officer or senior officer to determine if there is in fact fraud or money laundering, and if it is, a suspicious activity report has to be sent or has to be filed with FinCEN, F-I-N-C-E-N. And that file must be kept confidential and locked up for 5 years, and absolutely nobody is to know about it. Now, U.S. Patriot Act, All borrowers and donators of a gift must be run through the OFAC website. Those got to check to see if they're on the federal watch list. If anyone is, well, you're going to have to contact OFAC to make sure that everybody is good to go. If it's not, if it's on that list, they got to contact them to find out what they will allow you to do. Now, red flags, here's some penalties. $3,500 per violation, plus $2,500 if FTC gets involved. Big one, if you are caught doing referral fees, kickbacks, or anything unearned, you could be subject to a fine up of $10,000 in an orange jumpsuit for a year. Don't think you want to do that. Now, the Dodd-Frank, very heavy penalties. For any violation of a law, rule, or final order, a civil penalty could be up to $5,400. Now, on the test, it may be $5,000 because there's been some cost of living increases. Now, if you are recklessly engaging in violations, could be up to $25,000 or up to $27,000 with with cost of living. Now, if you are completely omitting, involving fraud, deceit, manipulation, now you're up to $1 million fine. So I hope you got a really big piggy bank. Okay, general mortgage. On the test, do not ever answer the question of the types of properties, any residential. It's got to be 1 to 4. Any residential means 5, 6, 7 unit apartments. Well, those are residential, okay, but not covered under any laws that are going to be on this test. 1 to 4 family residences only. Gifts must be a blood relative, company, but no evidence of repayment, I'm sorry. Now, loan to value on a purchase. You take the purchase price or appraised value, whichever is less, and divide that into the loan amount. It gives you your loan to value. Debt to income is DTI, which is total verified gross income, total verified debts, income into the debts gives you your debt to income ratio. Loan to value, that's the first mortgage balance divided by the value. Combined loan to value is the first mortgage plus any money drawn from the HELOC or second mortgage divided by the value. Total loan to value, or TLTV, is the first mortgage plus the total HELOC or the second mortgage divided by the value. Those are 3 good calculations you should remember. Now, PITI, principal, interest, taxes, and insurances, and that includes homeowners, flood insurance, and also could be HELOCs. HOA dues on a condo or something like that. Now, some terms. Table funding is for a mortgage broker or even a mortgage banker who is not funding the loans. They're turning the loans over to a wholesale lender. They're underwriting it. And then they provide the money at the closing. That's why it's called table funding. Mortgage banker, any company that can underwrite or fund loans. Now, a mortgage banker can operate as a mortgage broker and as a mortgage banker. Mortgage broker, they can only operate as a mortgage broker because that's the way they're licensed. Now, yield spread premium, or YSP, is money paid from the wholesaler to the mortgage broker. Now, without that money, the yield spread premium, That pays your commissions and also keeps the company operating. Now, an extended lock agreement is for usually something over 60 to 90 days. Could be because on a new construction, or it could be somebody that's got an extended lock period. I mean, ownership. The seller wants to stay in for a little longer. Now, cannot be issued by a mortgage broker, and it must contain the following: program, interest rate, cost, and of course, the expiration date. Delinquent loan is any loan over 30 days due. Discount point, very, very important. It could be bona fide discount point or discount point, which is 1% of the loan amount. But any money collected on a discount point cannot be used for any other reason but to reduce the interest rate. Now, premium pricing is used to help the borrower pay the closing costs. Now, how do they get premium pricing? Well, the interest rate's going to have to be increased. So if somebody says, well, I'd like to have you as the lender, pay 3% of my, up to 3% of my closing costs, well, the interest rate's going to have to be increased to reflect in your premium pricing. Now, premium pricing cannot be used to pay the discount point. The discount point can be paid by the company that is the borrower's company or the seller. Now, there's two types of refinances. Cash out, where you're taking equity from the loan. Rate and term, they're either going to reduce the interest rate or extend the term. Why? Well, they want to reduce the payments. Now, there are one more refinance that could come into play, and that is you're refinancing a ARM product to a fixed. Again, it's a benefit to the borrower. Now, right of rescission, it's 3 business days, not including the date the docs are signed. So if I sign the docs on Monday, I have the right of rescission on Tuesday, Wednesday, Thursday. 2 copies of the right of rescission must be given to every borrower or owner of the property. Now, if the borrower rescinds, you have to refund every cent they paid, appraisal, credit report, anything they've paid within 20 calendar days. Now, a mistake is made on the right of rescission, guess what? Your right of rescission period goes up to 3 years, not 30 days. I mean, not 3 days, but 3 years. And right of rescission is only on primary residences. Second homes and non-owner are not covered. Now, conventional conforming, those are loans that can be sold to Fannie Mae or Freddie Mac. Maximum loan to value is 97%. Any loan above 80% must have MI and escrows. Now, on the test, you can only use 28 for housing, 36% for overall. Now, that may not be the way the world is operating today, but for the guidelines for Fannie and Freddie, it's 28 for housing, 36 for overall. No term over 30 years. Now, no prepayment penalties, and conventional do not allow any assumptions. So nobody can take over an existing mortgage. Non-owner is allowed. Of course, there's going to be differences in down payment requirements and pricing. Now, non-conforming, very simply said, if it can't be sold to Fannie or Freddie, non-conforming. So all of these non-QM or non-conforming products like the bank statement loans, any of that, since it can't be sold to Fannie or Freddie, it's a non-conforming. Now, non-traditional, the government had to just kind of muck up the business here. That's any loan that is not 30-year fixed. So 15-year, 20-year, 1-year ARMs, 5-year ARMs, anything that's not 30-year fixed is considered non-traditional. Now, USDA, in areas of less than 35,000 people, could be 100% financing. But there are some income limitations because they count all income for every person occupying the property. Ratios are 29:41. MIP is required on the life of the loan. The big thing that's different is USDA must underwrite and fund all loans. All of the other programs we're going to talk about, the lender has to have the money at closing. USDA says, no, you don't have to do that because we will fund all loans. FHA, or Federal Housing Administration, they insure loans. They don't guarantee them, they insure them. Meaning at the time of a claim, the lender will submit the claim, FHA will pay the claim and get the house. Now, the maximum loan to value is 96.5%. 31:43 underwriting ratios. Now, mortgage insurance premium, or MMI, which is monthly mortgage insurance, is required for the life of the loan if it's over 90% loan to value and a 30-year fixed. Seller's concessions are limited to 6%. Now, VA loans, you're going to need 2 documents. DD 214 from the borrower that says, by the way, I have benefits. Don't know how much. The information is loaded onto the VA website, and a certificate of eligibility or entitlement will be issued. If it's 100% benefits, 100% loan. The lower the benefits, the higher the down payment. The overall ratio is 41%. They don't have a front end ratio, but they do have residual income. They're saying number of people times the VA factor, whatever's applicable for that part of the country, plus the house mortgage payment, plus any debts, must be less than the net income. Now, adjustable rate mortgages, 5/1 ARM. The rate is fixed for 5 years, and then it adjusts at the end of the 5th year and every year thereafter. The caps, there's 2 caps, 2, 5. The 2 is the adjustment cap. So every time the interest rate adjusts, the interest rate limit could only go up 2% nor down 2%. That's only on the adjustments. Now, the second number could be 5 or 6. That number is added to the starting interest rate. Let's say it's 4. That means the highest the interest rate can ever go is 9%. Okay, the margin is the only number on an ARM loan that can't change because it's the floor, meaning the investor is not going to allow the interest rate to go below that because that's what their return is they want on the loan. Now, the index, the most common index today is LIBOR. Could be Treasury, but most cases it's going to be LIBOR. Now, The SOFR, SOFR, is going to be the new index. It's already starting to go into effect, but definitely it has to be in effect by 2021, and LIBOR will be put to sleep. I don't know what's going to happen to all of the loans made with the LIBOR index. That remains to be seen at this point. Now, an important number here, or term, fully indexed rate. Do not add any numbers other than the index and the margin. Index and the margin. No other numbers would you add together to get the fully indexed rate, which is really considered as the market rate. Okay, reverse mortgages. Of course, it's negative amortization. Why? Because there's no payments. The interest is going to be added onto the principal every month. There's no escrows. The borrower is responsible to pay their own taxes and insurance. Minimum age, 62 years of age. And if either one of the parties is below 62, they cannot be on the loan and would be considered a non-borrowing spouse. Counseling must be completed before they can even apply for a loan. It's also called a non-recourse, meaning if the mortgage balance at the end of the loan is higher than the value, FHA is going to absorb the loss. Second liens. The most common are purchase money seconds. Could be a seller carryback, where the seller is going to carry back part of the down payment. Now, the other ones, most popular, are 80-15-5 or 80-10-10, meaning the first number is the maximum loan to value. Why? Because they don't want to have mortgage insurance. The second number of 10 or 15 would be the amount of the second mortgage. And the third number is the amount of verified assets the borrower would have to have. Now, HELOCs, home equity line of credit. The term is usually 8 to 10 years. The interest rate is floating. No principal repayment is required unless the borrower decides they want to put money back into their HELOC. Now, the borrower doesn't pay any money on the HELOC unless they draw. Now, once they draw, they will pay interest from the day that they draw until the end of the month. And then every month thereafter, they will pay the interest on whatever the balance is that's outstanding. Now, second mortgage, a little different. There, all of the money is going to be paid out at closing. They will start monthly P&I payments within 45 days. The term is usually 15 years, and it could be an ARM or a fixed rate mortgage. Now, subordination agreement is, I've got a first mortgage over at company A. I got a second mortgage over at company B. In order for me to refinance my first mortgage, I have to get permission from the second mortgage lender, and they have to sign the subordination agreement saying, I'm going to stay in the second position while you refinance your first. If there is no second mortgage, I mean, if the second mortgage won't do it, won't sign the agreement, guess what? They don't, you don't refinance your first. Okay. Now, the 1003 is the Uniform Residential Loan Application. Assets, you got to have enough assets to verify your down payment and your closing costs. Now, the long term can be used to cover the 2 months reserves. Doesn't have to be cash, just have to see that it's available. Now, 2 months reserved on owner occupied. All non-owner occupied will most likely require 6 months reserves. Now, it's verified by 2 months bank statements or investment statements or verification of deposit. Now, all income for Fannie or Freddie, FHA, USDA cannot be cash, verified with at least 2 months W-2s, 1099s, or the most recent pay stub, or the tax returns, 2 years. But you got to have a 4506T, which is sent to the IRS. When it comes back, if it doesn't match up your tax returns, 9 times out of 10, you probably have fraud. Now, self-employed, you need 2 years tax returns. And if they own 25% or more of the company, guess what? You need 2 years company tax returns and an operating statement. Now, any self-employed, overtime, bonuses, commissions, capital gains, you need 2 year history, and that there's a possibility of 2 to 3 years worth of income going forward. Without the 2 year history, you cannot use any of that. Now, TRID, you got the LE, the intent to proceed. Now, the intent to proceed, until you have that signed, you cannot order the appraisal. The loan toolkit, charms booklet, preferred providers list, affiliated business, and the homeownership counseling are to be delivered within 3 business days. Not sure what 4 hours means. Any change circumstances requested by the borrower or natural disaster could require a new LE, and a change circumstance is required within 3 business days. This is a weird one. The final LE must be received by the borrower no less than 4 business days. Everything on the mortgage business is 3 or 7. This is the weird number, 4 business days before closing. The initial CD must be received by the borrower at least 3 business days before closing. Now, consummation is when the borrower is legally obligated. That means when the loan is funded. Now, you got the 3 credit reporting agencies. Each credit report will have high, low, and middle credit scores. And the FICO, payment history, credit utilization, all of these items could be used to give you your Fair Isaac or your FICO score. Title insurance covers the lender and the borrower prior to funding, that there may not be any flaws. Now, closing agent is responsible to figure all of the, and approved by the lender for all of the document, all the figures. Now, a mortgage is a voluntary lien against the property. Now, keep in mind, the first lien is against the property, whichever files their first at the recorder's office. So if the first drops the ball, the second records their first, oh well. Now, IRS tax liens must be paid off at closing. On a refinance, IRS tax liens, mortgage and mechanics liens must be paid at closing. Now, a business day. On closing and right of rescission, it's any day, Monday through Saturday. If it's on the LE, intent to proceed, or the final LE, Saturdays don't count unless the company opens. The responsibility of the MLO and the company is to show that the borrower has the ability to repay. We've already talked about that. Right of rescission is only required on the primary. Appraisals, the big thing here is as is or with repairs. With repairs could cause a new LE if the borrower is paying for the inspections. Homeowner's policy has to be paid up at and bring to the closing, but it's no less than the mortgage, but no more than the value. Now, flood insurance, same rules as a homeowner's insurance, but if you see A, V, or D as the flood zones, you have to have flood insurance. Any loan over 80% must have mortgage insurance. Now, calculating income. Hourly wage times the number of hours times 52 divided by 12. Overtime with 2 years history, but using time and a half. Paid every other Friday, pay amount times 26 divided by 12. Paid on the 15th and the 30th, pay amounts divided by 24 divided by 12. Now bonuses, if the bonuses are going down, you have to use the loan number. If the bonuses are going up, you average. Now Social Security, if it's taxed before the borrower receives it, you can do what they call grossing it up by 25%. Okay. Now, be careful on this. If a question comes up, if I'm putting down a minimum of 3.5%, be careful that you don't answer the question 96.5%, because if the question is asking the maximum loan amount, that's 193. FHA loans require MIP 1.75 up front, 0.85 on the renewal. Now, flood insurance is required over the life of the loan as long as it's in the FEMA map. Can't be removed unless the property is removed, and it's any portion of the property. Condo or PFA may be required to be included. Now, I'm not going to go through all of these. The biggest thing here is the first sentence. You are working for the borrower, but you must protect your company. Everything about that. And every borrower has the right to apply and be given equal credit. Redlining, if you decide you're not going into any place to borrow, that's considered redlining, cannot be done. Reverse redlining, you're going into an area because you think you're going to be able to get higher interest rates and costs. Steering, you can't tell a borrower to live in a certain area or force them to take a program. Okay. Now, M&O licensing. You have to work, if you're working for a non-financial company, you have to be licensed. Those are called non-financial companies. There's only state licensing. There is no federal license. And whenever you want to apply for another state, you got to apply for their state at that and meet their education requirements or tests. There aren't any tests other than this one federal. Now, the NMLS, Nationwide Multi-State Licensing System and Registry. Make sure you keep that in mind, that it is nationwide, multi-state. Okay. CSBS and ARMOR are the two agencies that oversees NMLS. And you must be sponsored by a licensee of the state, your company, before you will be issued a license. You can't be a free agent. To get licensed, you need the 20-hour. You need to pass the test with a 75% score, a background check including credit, applying for a license, and being sponsored. And guess what? You get to pay them every year. And you have to take 8 hours of CE, which is good for every state in the country once you've completed it. But you have to pay your licensing fees between November 1st and December 31st. If you don't, your license lapses. If you don't do it by March 1, your license is suspended, and now up to the state to decide what they want to do. SAFE Act, secure and fair enforcement. Now, non-financial felonies. You can apply for a license 7 years after conviction. Financial felonies, fraud, money laundering, embezzlement, anything like that, you're banned for life. Child support has to be current. Now, any closer, processor, or underwriter does not have to be licensed unless they're under item A, taking or soliciting loans, negotiating terms, or expecting compensation. Any one of those, you must be licensed. Now, the MU1 is the company application. MU4 is your application, which you have to keep up to date, and any changes have to be made within 10 calendar days. Make sure your NMLS number is on all of your marketing and everything, any document you need to sign. Now, if you get a complaint or violation letter from the state, you better respond within 30 days. If not, sorry, they're going to assess the penalties as they see. Last thing, transitional license. If you are with a bank or you want to move from one state to another or apply for another state, you can apply for a 120-day temporary license. You must complete the 20 hours, pass the test, clear the background check, and be sponsored by the licensee within that 120 days. Now, any loans that you originate and aren't funded by the end of that 120 days, you will not be able to be paid commissions on those loans because unlicensed loan officers can't be paid. So be careful on the 120 days. Okay. I know we covered a lot. I talk fast. We're going to send you a copy, and we will give you, there'll be a copy sent to you, and there's a recording of this. Now, if you're interested in 1 hour or webinars for tutoring one-on-one, it's not group, we will do the best we can do scheduling you. And if you are a new person to the industry, I would give yourself to do a 4 to 5 hour tutoring to get you through all the materials so that you're ready. Okay, that's it. Thank you very much for being here. I hope that I was able to give you enough information to get started, and hopefully you will sign up for some tutoring And I look forward to working with you. And if not, only the best on your test. And congratulations when you take the test, only the best. How do you sign up? Contact your MEC representative. Go into their website and you can contact. They will set you up with a program that you would like. Okay. All right. Thanks, Nicole. Have a great day. Have fun and talk to you soon. Still there, Sarah?
Yep.
Okay. All right. All right. Went over a little bit.
That's okay. A few people thought it was going 4 hours, so.
Oh, jeez. Well, for free, I can't believe it. All right. Well, we're all set. Thank you, sir.
All right. Thank you. Bye.